This is problem 12.5 from Chapter 12 of Brigham and Houston, Fundamentals of Financial Management, Concise, 9th edition. And here we're asked to apply some basic capital budgeting concepts. And in general, when companies are trying to choose from a selection of projects, they want to choose the package of projects that has the highest net present value. All right, we're not given that information in here. What we are given is some information over how much money they can raise and what the internal rate of return is on several projects. Now, this is how companies usually work. They go and calculate what capital is going to cost and then compare that to what the IRR is on the projects. You take the projects and you rank them from highest profitability to lowest profitability. And then you go and buy all the ones you can afford. For this firm, the company mostly raises equity from retained earnings. And so it's going to have retained earnings of $2.5 million. So the first $2.5 million of capital they raise is going to cost 10%. That's given in the problem. And then if the company issues new stock to raise additional beyond the $2.5 million, so if they need higher than that, the cost of capital will go up to 10.8%. All right, so this is a no-brainer. Anything that costs that earns more than 10.8 would be a good project. If you took project A and project B, between them, the cumulative amount of capital would be $1,700,000, and then somewhere when you got into project C, you're going to have to be using the higher cost of capital number at 10.8. So you quickly used up that first $2.5 million. So the total number of projects that you ought to take are A, B, C, and D, and the total cost would be $2.5 million that cost 10%, and then you're going to need another $2,400,000. Oops, call that $1,400,000 at 10.8. So the grand total you're going to be raising, or this company be raising, $3.9 million. The highest marginal rate, 10.8, and the average rate between those two would be about 10.3%. So the optimal answer is to accept projects A, B, C, and D. The optimal capital budget is $3.9 million. That's the cost of A, B, C, and D. These other projects don't meet the cut because, and sometimes students say, oh, well, we'll just use this $2.5 million to pay for these. It doesn't work like that. It's like in your wallet. Oh, I'll use the $10 bills to pay for this, and I'll use the $20 bills to pay for that, like there's any difference. So you just rank order the projects from most profitable to least profitable, and you start spending money until you run out of profitable money.